This video will cover the Federal Reserve System and domestic monetary policy. The Federal Reserve System was established by Congress in 1913 to control the nation's money supply. It was felt that the money supply needed to be managed and controlled from a high level in order to try to even out the problems with the economy and recessions that we've had over the years, over the decades. You know, the 1700s, 1800s, we would, as an economy, go into recessions. It often affected banks, often caused banks to collapse, and so it was thought that if we could control the money supply and also try to shore up the strength of the banks using a Federal Reserve System, the nation would be much better off. Most other countries around the world had central banks for hundreds of years, and they worked fairly well. In our country, people were afraid of centralized banking and the power that would go behind centralized banking. And so we were slow in developing a central bank system. You know, that problem that we have with centralized power still exists today, as people still bash at the Fed about its centralized power that it has. But in any case, let's talk about what the Fed does and how it tries to manage and even out the ups and downs in the U.S. economy. Technically, so let's give you a little more background about the Fed itself to give you a better context about as to how it's operating. Technically, the Fed is not part of the government, but it does report to the President and Congress periodically, and the President and Congress appoint key officials to the Federal Reserve System. The Congress did set up the Federal Reserve, but it doesn't really control the Federal Reserve, so it's sometimes called a quasi-government organization. The Fed has a mandate from Congress, and there's two main components to that mandate. And the first one is to maintain stable prices. And historically, for a very long time in this country, that meant goods prices, goods and services. And so that's what the Fed managed to control what we think of as inflation. In the 1990s, Alan Greenspan, the chairman at the time, realized that he could, and the central bank ought to, extend the definition of prices to mean not just prices of goods and services, but also the price of stocks, for example, equities, bonds, which in part reflect interest rates, which really reflect interest rates, and also real estate. Because if you don't control prices, or at least try to consider the impact of prices of the stock market and real estate, you're really not doing a good job in trying to balance the economy out. So stable prices is the number one. I shouldn't say number one, is one of the two big mandates of the Fed. The other one is full employment. And so the Fed is expected to try to control the economy I shouldn't say control, but manage the economy as best it can, given its tools, to maintain full employment, which means basically try to keep us out of recessions. The Fed, by the way, also has other responsibilities that I should note here. The Fed supervises and regulates banks. It is considered also a bank for the banks, as we'll talk about. It issues paper currency for the Treasury on behalf of it. Often works on behalf of the Treasury, U.S. Treasury, which is responsible technically for the notes, the bills that we have in circulation. The Fed also clears checks, and it deals with financial crisis. Well, it has to deal with financial crisis if it needs to maintain full employment and keep stable prices. Now, the traditional tools for the Fed are this. There's a couple tools. There's three main traditional, called this, traditional tools that the Fed has to manage the economy. One is to set or to change reserve requirements. And I'll define what that means in a few seconds. Let's go through the other tools. First, outlining it. It can set or change interest rates. The interest rate at its discount window. And the way to think about that is the Fed is a lender of last resort. So if banks are in trouble and they need to borrow money and they're unable to borrow money from other banks and other financial institutions in the economy, the Fed is there to back them out as a backstop. And so the Fed will lend money to a bank that's in trouble, and the term used for that is the way it's gone about is they go through what's called the discount window in order to borrow that money, and there's an interest rate associated with it. So the Fed can decrease that interest rate if it wants to entice banks to borrow money from the Fed. So that's a tool that's used to manage the economy and to keep us from a banking crisis. The third method, the third tool is to manage interest rates. Third traditional tool of the Fed is to manage interest rates through the buying and selling of treasury bills in what's called open market operations, OMO, open market operations. And so what I'm going to do is I'm going to talk about open market operations and how that works, the buying and selling of treasury bills between the Fed and the banks. And then in that process of discussing that, I'll be talking about the reserve requirements and how they play a role in it. Okay. This number two, set the interest rate at its discount window. It's kind of a separate concept. It's not used that often anymore, but it is relevant. But the real key players is number one and number three here. So let's get into it. And in order to get into it, we need to cover some definitions. Okay. The first thing is, let's define money supply. So the Fed is trying to manage the economy using the money supply. And the money supply is made up of cash in the hands of the public. In other words, cash in circulation plus checking deposits. Okay, that is the definition of money supply. And so think about this now. This is the money that's in the pockets, cash registers of people and businesses, and it's also the checking accounts that people hold at banks. Checking deposits are considered a extremely liquid source of money, basically. So you can convert your deposits into cash quite easily, and so it's considered part of the money supply. There are various definitions of the money supply. This is M1 if you're interested. There are other definitions, M2, M3, which really we don't need to get into. Just think of the money supply as being cash in circulation plus checking deposits for now. Now, another definition that we ought to know about, it'll help us, is reserves. It's a little more abstract. I think the money supply is not too hard when you define it as money in circulation and deposits, but reserves is a little more abstract. Reserves, according to our to where we are in talking about the Fed, is equal to cash in the vault of a bank. So basically what it means is you deposit money in the bank, and the bank needs to keep a certain portion of that money on reserve in its vault in case you want to withdraw your money from the bank. It can't just loan all of its money. All the money that you deposit can't be loaned out. Otherwise, if there were a number of people trying to withdraw money, there would be no money in the vault to do that. And so the bank would run into trouble, and it could go bankrupt or have to call on the Fed to bail it out for liquidity purposes. So the Fed sets reserve requirements that banks need to maintain. And so reserves are cash in the vault plus balances on hand at the Fed. And I should put balances on hand at the Fed because that's a somewhat even more abstract term, which will become more clear as we go along. Now, so like I said, the Fed sets up at the Fed, not Feb, the Fed. Sorry about that. The Fed sets reserve requirements, often denoted as RR, and the reserve requirements we typically assume for academic purposes in a basic money and banking course. Basically 10% you can think of. That's not too far off. In other words, if you deposit $100 as an individual in a bank, the bank needs to maintain $10 in its vault or somehow on balances on hand at the Fed. Okay, so 10% reserve requirement, and that's calculated by taking the reserves that each bank has and dividing it by its deposits. So when you have that fraction, this is that concept of fractional reserve system. It needs to keep a fraction of the reserves to be 10%, and that's not unlike most of the banks around the world follow the same concept. They're fractional reserve banks. Now, one other thing, while banks have a reserve requirement, they often don't lend all the money that they can lend out, in which case that means they have money in excess of their required reserves, and those are simply called excess reserves. That's excess cash on hand that's unlent that they have the ability to lend out and still meet their reserve requirements. That's excess reserves. The other thing you're going to need to know is that if a bank runs short of reserves, it can go into a market called the Fed funds market. Okay, the Fed funds market is a market for reserves among the banks. So what happens is we have thousands of banks across the country, and a lot of those banks, let's say half the banks have excess reserves and half the banks have, reduced reserves. They have less than what's required. And so the banks that have excess reserves are going to lend money to the banks that are in need of reserves. So there's a market out there, and the market is called the Fed funds rate, and the interest rate, which is the price of that money or reserves that's going back and forth, is called the Fed funds rate. Okay? So this is a huge market that you don't hear too much about nowadays, but it's a market between banks. It's usually, as individuals, we can't tap into the Fed funds market. Because the transactions are in the millions of dollars for each transaction. There's probably trillions of dollars a week running through those accounts. But that market is designed to make sure that banks that have excess reserves can lend them out. Why would they want to lend out their excess reserves? Because they're in for a profit motive. And if they lend these excess reserves out, they can earn interest in an interest rate. There's an opportunity cost to holding excess reserves. And if you're deficient of reserves, you need to be accountable to the Fed. And so if you're deficient of reserves, then the Fed could shut you down for not meeting the reserve requirements. So you have a desire to meet those reserve requirements or be shut down. So you'll borrow the money that you have to. Now, if you can't borrow money through the Fed funds market for some reason, let's say a bank is, the Wall Street knows that a bank is going under and it's not doing well. Nobody's going to want to lend to that bank because they're not sure if they're going to get their money back. That's where the discount window comes into play. This guy that we talked about. So if a bank runs into trouble, can't borrow in the private market, it's the Federal Reserve is a lender of last resort. It's the bank for the banks, and it will lend money through its discount window and charge an appropriate interest rate called the discount rate. Okay, now let's talk about how the Fed what the Fed is ultimately trying to do, and then we'll go through the mechanics of how it works. So basically what the Fed is trying to do is it's trying to manipulate interest rates, trying to manage. So I got to be careful here, and you should be careful, that we're talking about managing interest rates, not controlling it. The Fed doesn't control it. The Fed doesn't actually set the interest rates in the economy. It tries to influence them. It influences them through open market operations, which I'm just starting to get into here in this video. And it also does it through a concept called jawboning. And jawboning means they talk the markets into it. If you have a credible Fed, a Fed that you have confidence in, then when the Fed says something, people listen and they believe it and they act accordingly through a concept called rational expectations. So if the Fed says, we project we're going to start lowering interest rates in coming months, then the market starts to react to that and moves in a way that has expectations for lower interest rates. And it's kind of like a self-fulfilling prophecy in a sense. Okay, if the Fed says it's going to raise interest rates and it's announcing that, and if it's credible, the people in the economy have rational expectations, they're going to start acting as though interest rates will be rising in the future. And that's, again, a self-fulfilling prophecy. They can do that without doing anything other than talking in some cases. That's called jawboning. So we'll talk about, jawboning is important, but we'll really want to talk about how open market operations work. But here we want to get to the price of money. Interest rates are the price of money. So here I'm starting to draw a graph as I'm talking about the price and quantity of money. Normally we have P here and Q here for the supply and demand of the price of apples, or the supply and demand for the price of oil. But when you're talking about money, the price of money is interest rates. And this will be a short-term interest rate. Call it I. And this is the quantity of money. Okay? Quantity of money is on this axis. And so you can have the demand for money, we'll call it MD. MD is the amount of money that's demanded by the public. And when I say amount of money demanded for public, I mean the amount of money that they want to hold in circulation in their pockets and in cash registers, plus in checking deposits. Because remember, the money supply is made up of cash in the hands of the public plus checking deposits. So this is a downward sloping curve. And why is that? Well, when interest rates in the economy, short-term interest rates, are very high, and you're up here, there's not going to be a lot of demand for checking deposits or cash in the hands of the public, because there's a huge opportunity cost associated with that. So the quantity demanded will be low when interest rates are high. Now, when interest rates are really low, kind of like where we are in today's environment, then the quantity demanded will be relatively high. There's very little opportunity cost to holding money in your pocket or in a checking deposit. Now, I'm assuming, and it's a pretty valid assumption, that checking deposits pay no interest. Some of them do, but the interest rate on those deposits are so small, it's basically negligible. So we ignore it. Now, that's the demand for money. There has to be a supply for money, and that's what the Fed helps determine. Okay, remember, see what I say? Helps determine the money supply. It manages it. It tries to manage and influence it. And I'm trying to get away from telling you that they're controlling the money supply, because the markets help determine this money supply. So there's going to be the money supply, and that's generally assumed to be independent of the interest rates. So the money supply is often denoted as just a straight line, vertical line on this supply and demand for money. And so what happens is when the Fed wants to increase the money supply, it increases the money supply, moves the money supply curve out, and interest rates go from this point down to this point. And so you have a lowering of interest rates through the increase of the money supply. When you lower interest rates, so the way economists often will depict this is you have lower interest rates. That leads to more investment. Okay? Now that's the investment. Remember, gross domestic product equals consumption plus investment plus government expenditures plus net exports. Remember that from basic macro. When you lower interest rates, you're mainly spurring investments because now it's cheaper for companies to invest in new plant and equipment and new products and to help spur the economy because that increases gross domestic product. Also, the lowering of interest rates also helps increase consumption also. And there's a number of mechanisms for that, but it just means that the borrowing of money to consume is a little cheaper, so people will consume more. Find ways to borrow money to consume, so consumption is likely to go up. Okay? But let's just stick to the I. That's the main channel in which lower interest rates affect the economy. I guess some people would argue consumption's in there too, but let's think of I for now. And so when interest rates fall, investment goes up, and that means GDP goes up. And that leads, when GDP goes up, how do you produce more goods and services? Well, you need to employ more people. And so there you see, increasing the money supply improves the economy, and then employment increases. Okay, easier said than done. There's a lot of this channel of monetary policy, as it's called. There's a lot of things that have to go on before lower interest rates happen. Between changing money supply, I should even back up here. So we increase the money supply, goes up. There's a lot of discussion as to how does this actually work. Increasing the money supply drops interest rates. I'm showing you graphically, but there's lots of literature on that. And then how does lower interest rates translate into higher investment? There's a lot of literature on that in discussion. And then by definition, it's going to pump up GDP. Just mathematically, that's just a math concept. And then the big question is, okay, if GDP goes up, are we sure employment's going to go up? And there's a lot of literature on that also. So in any case, we have to believe that this entire channel works. And it does for the most part. It does. Now, let's talk about open market operations and how the Fed would tries to control this. So the way to do that is let's look at a bank's balance sheet. So let's say we have two banks. In fact, we're going to put two banks here. We're going to have Bank A, Bank B. And let's say we have on deposit, I'll call it the P, D for deposit. $1,000 is on deposit. So you or I or other people, we've deposited $1,000 in a bank, and the bank has to maintain cash in its vault for reserves. Okay, I should spell it right. Vault. This pen is so thick I can't write clearly. Okay, so cash in vault is going to have to be 10%. If we believe in a 10% reserve requirement, that's going to be $100. Okay. Now, banks have a profit motive, so they're not going to want to try to hold on to much more in cash in their vault because they're going to be losing opportunity cost of money. So what they're going to do is they're going to loan out. They're going to loan out $900 of that in the market. Now, that doesn't always happen. They may not have the ability to lend out $900 in the market that they serve. So it could be that this is only $700, right? So they lend out $700 and they invest in treasury securities which earn a rate of interest of $200. So let's assume that that's what's happening here. So you have a balance sheet that balances. You have, remember, assets equal liabilities plus equity. Okay. Remember that basic accounting concept. assets equal liabilities plus equity. And so I'm ignoring the equity component. You don't need to look at that here for our banking concepts. It's there, but just ignore it for our simple exposition of the story here. So we have deposits of 1,000. The bank keeps 100 on deposit. $200 are invested in treasury securities that are low risk and that the bank is allowed to own. The bank's not allowed to own any type of assets. The Fed controls it because the Fed doesn't want banks to be investing in highly risky assets. So treasury security is an acceptable investment for the bank. And the bank is obviously allowed to make loans. And so you have a balance sheet now that balances 1,000 to 1,000 on both sides. Okay. Now, I'm going to leave, well, let me specify Bank B just a little bit right here. Let's say Bank B has deposits of 700, keeps cash of 70, and has loans of 630. Okay? So that balance sheet for B balances nicely. Okay. So now we have Bank A and Bank B, but we don't have any Federal Reserve Bank at this point. Well, let's create one. No, it's 1913 again, back, and so we can create a Federal Reserve. We can create one out of scratch, basically. And so here we have Fed, and we have the Fed's balance sheet, and we put it up here because it's in charge of and oversees the bank, the individual banks. And so let's now say the economy doesn't look good. You need to lower interest rates. You need to spur economic growth and investment. You need to get employment up. We're not concerned about inflation at the moment, so don't be concerned about that. Get the economy moving. And so the Fed figures out what it has to do. And let's assume that in order to do this, the Fed says, you know, we're going to increase the money supply. We're going to test out the waters. We're going to increase the money supply by $200. And so what we hope to do is we're going to push out the money supply here, $200, and watch interest rates drop. And if they don't drop enough, we'll increase the money supply even more. Okay? So here's what the Fed does. The Fed buys a T-bill. For $200, it buys a T-bill, so it's now an asset on the Fed's balance sheet. But in order for the Fed's balance sheet to balance, it needs a liability, something like this is a debit. If you had a more advanced accounting course, this would be a debit, and we need a credit side, which would be a liability or equity. We're ignoring equity, so what's going to happen is the Fed is going to create reserves out of nothing, out of thin air. It creates reserves of $200. So the Fed's balance sheet balances, as you can see. And what happens is this Treasury bill ends up on the Fed's books. So that Treasury bill is gone. It's off the books of the bank. And now the bank has reserves, I'll just call it RES, at the Fed of 200. Okay, and those reserves count just like as cash in the vault. So without the Fed having any resources per se, the Fed has purchased the Treasury bill. It's on their balance sheet, and they've promised to give backup to Bank A of $200. So Bank A has reserves at the Fed of $200. Bank A now has excess reserves. Because remember, initially it had $100 in deposits, or $1,000 in deposits, and $100 on reserves. So it met its reserve requirements at 10%. But now it has 200 out of 1,000. It has excess reserves. Oh, it has 300 out of 1,000. It has excess reserves of $200. That means Bank A, if it has a strong profit motive, it's going to want to lend that $200 out. So let's say now it lends that $200 out. The market's pretty good. The Fed is signaling interest rates are lower, so maybe there's going to be loan demand now. And so now this bank is going to make a loan of $200. So the reserves So what's going to happen is these reserves are going to go off the books. Oops, this reserves will go off the books. The bank makes the loan of 200, right? And so now its balance sheet balances. Let me just try to, I guess you can see how this balances. There's still a $1,000 deposit. There's 100 in cash in vault. Assume that the bank has the liquidity cash, and I don't quite have it here in this simple T account. Just assume it has the cash to lend out the $200. And so your balance sheet, this balance sheet still balances at $1,000. Okay, so now it makes this loan, and some companies borrows that $200,000, takes that money, and eventually deposits it in another bank. So it's going to deposit $200 from that loan. Okay, and when you deposit $200 at a bank, the bank will end up having cash will increase by $200, okay, which means this bank here needs to maintain reserves of only $20 additional dollars, and it can lend out 180 of this. So what this bank will do, it now has excess reserves of 180, so it'll keep 20 of this on reserve. It'll lend out 180. And so now everything adds up to 900 and balances the 900 in this case for this bank. And so what'll happen is this will keep continuing to happen. So this bank now made a loan of 180, so you'd have Bank C. And we have different banks. You could all put it in one bank, but as you can see how messy the balance sheets are getting as it sits. So it's simpler to discuss by having multiple banks where the money gets deposited. So you'd have Bank C, where Bank C gets a deposit of 180, and then it gets cash ultimately of it's going to have to keep 10% of that, and then it's going to loan 90% of that, and it's just going to continue. And so what happens is, look what's happening. Deposits went from 1,000. They went from 1,000 and 700 initially, to now they increased by 200. They increased by 180, and the deposits keep increasing. Well, deposits are, by definition, a component of the money supply. So when the checking deposits go up, the money supply goes up. The money supply goes up, interest rates come down according to the graph. And so think about this now. When people and companies borrow money, they're borrowing money not just to borrow the money and sit on it. They're going to borrow the money and use it to buy property, plant, and equipment and make investments in that type of capital. And so that's where the I pops increases here. And people could be borrowing money to consume more also, because then you know even home equity loans could end up affecting the consumption. So you got an increase in I, and even at some part consumption increases and GDP goes up. But how do you increase production? You have to increase employment to get there, to help do that. And so there you have what the Fed's traditional policy tools are to control and manage. I shouldn't say back up, not control the money supply, but to manage the money supply. And so notice what happens. There's a couple of things. This whole chain of reactions depends on how market participants react to what the Fed is doing. So the Fed is trying to do this, and it's hoping that this pattern unfolds, but it doesn't necessarily always happen. The other thing you need to keep in mind is the Fed doesn't control excess reserves by banks. Banks sit sometimes on excess reserves. They may not lend it out. And if banks don't lend the excess reserves out, then the whole process of increasing the money supply stops dead in its tracks. So banks need to have a profit motive in order to spend and lend out their lend out their excess reserves. But if you're in a recession and there's not much loan demand, banks end up sitting on excess reserves. And so the Fed could try to increase the money supply, but it may be hopeless in a recession to increase the money supply using traditional tools, such as open market operations and the buying and selling of treasury bills, or treasury notes in this case. And it doesn't have to be just treasuries. It could be mortgage-backed securities of some sort, very short-term instruments to conduct this monetary policy. Now, also in a recession, especially in the recession of 2008, 2009, 2010 that we had, there was a liquidity crisis. Banks had no interest on lending out money. They wanted to keep as much cash as they could on hand because they didn't know if they would have the cash to meet their liabilities. So they refused to lend out anything. And so it stopped. So what happened was the Fed conducted huge amount of open market operations in the economy, but it had almost no influence on the money supply, because of the fact that banks did not lend that. It was excess reserves. It stopped the whole chain reaction, this whole chain reaction from happening. Okay, now, got my notes here. There are non-traditional methods of dealing with the money supply and trying to spur the economy. And these are methods that have only been around the past couple of years. And what their goal is to do is this. I'll show you here. So here is the yield curve. You'll be seeing this a lot in any investment management course. This is maturity, and this is yield. I'll put it in percent here. And this is treasury securities. And the maturity for 0, 1 month, 3 month, all the way up to 30 years for treasuries. The yield curve looks something like this in today's market. So this is today. If you look 10-year securities, 10-year treasuries, we're yielding extraordinarily low, 1.64%. That's very, very low. So that means you can buy a treasury bond or note that has a 10-year maturity, and the interest rate per year that this thing is going to throw off in terms of coupons, coupon cash flow, is you're going to generate 1.64%. Now, if inflation is 1.64% or higher for each of the next 10 years, you're going to break even or lose money in terms of real purchasing power. So interest rates are extraordinarily low in this country. There's a reason for it, and that's going to spur my next video, which will take a little while for me to put together, and that will be international central banking, and how we're just not in the world by ourselves. We need to consider what other countries are doing and what those central banks are doing to be able to figure, and those economies are doing, to be able to figure out why our yield curve looks the way it does. So this video covers mainly domestic monetary policy, which is what I tried to make clear at the very beginning. I will have to open this up a bit in the next video to talk about international monetary policy and international banking. Okay, so now back to our yield curve. So interest rates now, I think, this is a high. 30-year treasuries are somewhere around 2.23%, which is historically outrageously low. It wasn't more than a year ago. They were still outrageously low a year ago, and the yield curve looked something like this. And the yield curve was at 3.6%. And people said, including myself, holy mackerel, 3.6% for a 30-year treasury, that is really low. I can't imagine it going lower, is what I would have said and probably did say a year or more ago. And now look where it is. It's a lot lower. And now I'm telling you, it's at 2.23%. I can't imagine it going any lower. Let's hope it doesn't, but it could. But so what's the point of all this? Well, the point of all this is showing you this yield curve. There's a number of good reasons. One is all this open market operations stuff that I just showed you here. really what that does is it helps manage and helps to manage very short-term interest rates. This part of the yield curve, okay? This part of the yield curve is what gets influenced by monetary policy under classical traditional tools, okay? So, you know, the Fed doesn't have this open market operations is not that effective when interest rates are really, really low, because you can't lower them anymore. So you can do all this open market operations that I just described, which is still very relevant concepts there, and we've done in the past, and our balance sheet of the Fed and banks reflect what this is going on. But right now, the Fed is in a sense out of ammunition using those old tools because interest rates are at almost zero, which means you can't drive them any lower. You're basically on this graph, you got interest rates where you're down here. You can increase the money supply, but it's not going to do any good way out here. That's where the Fed has come up with new monetary policy tools lately, non-classical, non-traditional tools to try to get at this problem. And so what they've done is they've tried to influence the long end of the maturity spectrum, as it's called in finance and economics, to try to influence the yield curve on this end, okay, and to drive interest rates lower to increase consumption, increase investment, increase GDP, which in turn increases employment. And so the reason for influencing long-term interest rates is it's felt that in the market, long-term interest rates are what really count for companies to borrow. If you want a company like Procter & Gamble to build out a whole new product line, to build the property, plant, and equipment to do that, it's not going to be borrowing 1 month securities for 1 month or 1 year. They're going to be borrowing for 10 years, 20 years, or 30 years. So what you want to really do is influence long-term interest rates, bring down long-term interest rates, and it means that it just makes this relationship right here much stronger. Because if you remember, there's more than one type of interest rates. There's long-term interest rates, there's intermediate interest rates, short-term interest rates. And so if you can influence intermediate to long-term rates, you make this relationship much stronger. It's a much better channel. And that's what the Fed has been trying to do and has done. So its monetary policy now is not just buying treasury securities as it traditionally has done. It's now buying even mortgage-backed securities, the lower interest rate. So there you have it. Probably more than you wanted to know about what the Fed does and how it works things and how it influences interest rates and the economy. But understanding how this works in an investment course is very important, because the markets are watching the Fed and what's happening in the banking system. The interest rates, investments, and employment, they're watching it like a hawk every day. And so, you know, if you're a passive investor, you may not want to watch this every day, but if you're managing other people's money, and in this course, there will be people who want to make a career out of managing money. You can be a financial planner, for example. You're going to want to know what's going on with the markets because your clients are going to be asking. So it's important that you have this insight, more than a surface level insight as to what the Fed does.